Welcome investors, I'm wearing a festive shirt today and the Peaky Blinders hat because I had another good day in the market. I hope you did too. The market definitely seems to have bottomed and some of you hopefully are starting to see some traction in your accounts. I want to show you today kind of an advanced technique to supercharge your gains via what Mark Minervini calls asymmetric leverage. This is a technique I learned through Minervini's private access, which is an incredible training service that Mark Minervini offers. I'll put it in the description down below. And it involves big positions and tight stops via mostly high tight patterns. We'll get to that in a minute. So here's what we're going to do. First, I'm going to explain a common mistake that people make, which is the opposite of this technique. And then I'm going to show you the technique itself, how to de-risk it as much as possible. And then I'm going to show you a couple examples where it would have worked fantastically. Show you one of my trades that I have on right now, which it's working. And then I'll show you a couple charts where you could practice this technique on your own in the next few days. So yeah, let's get started. I've been investing since 1996. I specialize in technical analysis, although I do fundamentals too. I'm not a financial advisor, and this is just for education and entertainment. This is not financial advice. Do not take one of these trades unless it's your decision, not mine. Okay? So, first of all, here's a common mistake that investors make. They find themselves an uptrending chart that's pretty volatile. See this wild action, 20 or 30% swings, and they say, well, this thing is kind of a bucking bronco, so I'm just going to put on a small position and I'm going to give it a wide stop. I'm going to give it a 20% stop. Or worse yet, I'm not going to give it any stop at all. Then one of two things happens. First, it goes down 20% and hits their stop, or it goes down 20 or 30% and they're stuck waiting for it to get back to even. Or, best case scenario, it doubles or triples, but they only took on a tiny position. If you do a $100 position and it triples, guess what? You got $300. That's 3 tanks of gas. So that's not the answer to making financial progress in the market. What you want to do is asymmetric leverage. And here's basically, as I said, what that means is big positions, tight stops. And the best pattern formation for this is the high and tight base, or a tight cap, or a tight handle. Let me show you some examples and it'll be much more apparent. Okay, let's start with the H&R block, HRB. This is one of the stocks I've made good progress with this summer. Let me show you a couple really tight areas on the chart where you could have used this technique. So here we had this massive lift off out of first quarter earnings, I believe. And then you saw this little digestion period, this little unorthodox, very small cup, not even a month. Right side is a little compressed, but then we get a nice little rectangle, if you will. You see that tight little box there? And it is only about 4%. In fact, we could even narrow that down. Really, it's about 3%. So when you see the stock making a tight, in this case, we could call this a cap, a tight area on top of a base breakout, then what you can do is you buy when it pushes, when it breaks out the top of the box, and you set your stop really tight. Down here at 4%, maybe you even put it here, 36.5 at 3%. And because you are only risking 3 or 4%, you can put on a big position. You know, a $10,000 position with a 5% stop, you will lose as much as a $5,000 position with a 10% stop. if the stops hit. Does that make sense? And in this case, as you can see, broke out of the box and it took off. And then here it forms another box, right? This, we could technically call it a high tight flag. It's pretty short, but again, when it pushes the outside of the flag, you can go long, set your stop just above this tight area, and then you see what happens. You want to make sure that there's a previous uptrend, and you want to de-risk the trade. So you want to make sure that earnings have come out. Now this trade was risky because you were buying right into earnings. In this case, it worked out, right? But you should never put on a big position right in front of earnings. And you also check for product announcements, clinical trial results. Spend some time on the company investor relations website. Read the press releases and the news items, and make sure there's nothing coming out that you are aware of that can derail the trade since you're putting on a big position. Let me show you a couple more. We'll save this one. Okay, this is another stock I own, Murphy USA, MUSA. It's also been doing really well. Here's your prior uptrend. Then you have a pretty nice shallow cup here. You've got a wicked shakeout with earnings. I love to see a shakeout on the bottom of the base. And then here you have, here's your cheat area, but this is kind of a wide swing. But then after the breakout, as we see sometimes, you see a nice little cap on top of the pattern. Let's put a little box out around this for emphasis. Yeah, and let's just measure it. See, this box is only, again, it's about 3%. So we can use asymmetric leverage here. We buy when it pushes the top, when it breaks out of the top of the rectangle. This would have been on April 5th. We set our stop, a hard stop, put it into the computer. Don't just say, I'm going to sell if it hits this, because when these things break, they can break down so fast. You can be down, 10 or 15% before you can even get your order in. You put in your stop down here. In this case, it would have been at like 199. And as you can see, away you go. You'd still be in this stock today. Now, so you de-risk by watching out for earnings and product announcements and trials and so forth. And you also de-risk it by taking profits early. So if you have a big position on, as soon as you get, well, it's always a trade-off, but for me, 5 to 10%, when it starts to get stretched and then starts to pause, like right here, I probably would have taken off half, or at least a third. You can take off half, and then you can move your sell stop up to your initial buy point. And then essentially you've de-risked the trade. You want to de-risk these things as soon as possible. Of course, you don't want to make it too tight. You don't want to choke off the trade. But this is an art, right? So that's one instance where we can use asymmetric leverage. And I just opened a new position on this today. No, not today. A few days ago. Let me show you. I've been in and out of MUSA a couple times, and I just bought it again using this technique. So here's another nice high tight flag. Now, the thing I don't like about this, can you guess? Let me give you 3 seconds. The thing I don't like about it is it's getting pretty extended. This stock is already 13% above its last major base. But the market is getting pretty strong and the chart's strong. So I tried it anyway, and so far so good. So here's our rectangle, and it's very tight. It's only about 3% again. And I bought it on, I'll tell you when I bought it. I bought it on August 12th. And sure enough, it tried to break out yesterday, and today it's broken out very nicely. Volume is a little weak. I'd like to see volume pick up. But here's my position so far. I bought 10,000 worth of shares, which is 34 shares, up almost 2% now, up $188. Now, if I was really, I could just really tightly swing trade this thing and take the $200 profit and run. But I'd like to play it for a little bigger move. So I'm just going to watch it, and we'll see when it starts to look extended. probably somewhere between 5 and 10%. Then I will take off half of it. Like I said, move my stop. My stop was at, gosh, I forgot to tell you write it down for you, but I think it's at 284. But I'll move it up to my purchase price, which is 292.30. I'll do 35 to give a little wiggle room for, what's it called? Seepage? Leakage? I don't know. Yeah, and we'll go from there. So those are some examples. Let me show you a couple you can play later this week. I probably am going to try them too. The first one is, okay, I'm going to give you 4 of them really fast because I try to keep these at 10 minutes, and we're over 10 minutes already. This is OPCH. Here you got a nice tight base forming, tight flag, although it's not really a flag because it's not drooping down. Let's call it a base. And again, you could draw your rectangle by when it breaks out of the box, set your stop right beneath the box. Now you got to understand, you're going to get stopped out of these things 50% of the time. And right now, with this volatile market, it might even be 60% of the time. If you're not okay with getting stopped out 50 to 60% of the time, 40% when you're in a strong market, then this technique is not for you. But boy, like I said, you can pile up financial gains in a hurry. And that's the whole point, isn't it? Not making a huge percentage gain, but making those financial gains that'll change your life. That's OPCH. Next one is LNTH, Lantheus Holdings. This is a biotech, making again a nice tight flag here. Same thing. This, I'd like to see it extend for a few more days, but you certainly could try this technique. Buy when it breaks out of this little tight pattern. Set your stop right beneath down there at 80.5 or something like that. I've been in the stock for a while and doing quite well with it. PTCT, this is another biotech. It's de-risked because earnings just came out, and this looks a little volatile, but if you measure it, it's only, oh, what is the problem here? Come on, computer. Okay, sorry. It's about 5%. So, and it's down here at the bottom of this little tight area. So I would probably wait for it to get up. Maybe wait for it to move above today's candle, which is 53.4. Wait for it to get about 53.5 or so, and then go for it. Set your stop. Maybe if you're not comfortable with 5%, maybe you put it within this little wiggly base. Maybe put it at 52.5. Realize there's a good chance you're going to get stopped out, but the reward is worth the risk. Well, that's a strategy I learned from Mark Minervini, Minervini's Private Access. Let me know if you have any questions about that, or if you've used this technique before. And I encourage you to try it out sometime, and let me know how it goes. Some are going to work, some are not. But you keep flipping that coin, you're going to make some money. All right, take care, everybody.